Hello and welcome, everyone. I'm Keith Casey, and today we're here to talk about APIs in the regulated world. So first of all, I'm Keith, as I already said, and I'm here with my partner Venkat, and we're going to talk about APIs in the regulated world and sort of how some of it came about and sort of the reasoning behind it and what the future looks like. So with that, I'm going to go ahead and dive in. Of course, you know Okta is a publicly traded company, so anything we talk here about the future or roadmap has a big caveat next to it. If you want to check out the safe harbor statement, definitely check that out. But we're not going to do it in this session. Just read it when you get a chance. So that, I want to roll back to the very beginnings of banking. If we think about banking roughly 150 years ago, it all comes down to this. This is the ledger. The ledger was the foundational concept that everything was based on. It basically tracked every amount coming in versus how much was on hold, on deposit, and how much was going out. Everything revolved around this. This is what determined whether a bank had liquidity, if it could do lending, whatever reserves it had on tap, all those sorts of things. Now, there's a lot of complexity that came with this, though, because fundamentally, a ledger, it's a pain. It takes a lot of time to keep up to date. And this is why if we think about how banking, in some cases, still works today, the accounts, the amounts, the direct deposits, things like that, don't move until a particular time of day. That's all those banks getting their books back in sync, making sure this works out. Now, this started to change a little while ago. We think about roughly 20, 25 years ago, the beginning of the 2000s, PayPal was one of the first things to start shaking this up. Suddenly, we had this entity that's able to move money from one person to another with a lot less effort. In some cases, without a bank involved. Yeah, they look and act like a bank in a lot of ways, and they are legally, but let's set that aside. But we start thinking about the challenges and complexity that came with that. It starts to get really interesting because now we're leaping over pieces of the system. Now, if we go a little bit further, we go about 10 years ago, the advent of iPhones and smartphones in general radically changed our relationships with banks again. We weren't waiting for our monthly statements. We weren't going to a web page and checking to see how much was there. We weren't going to the teller to withdraw money. We could pull out our supercomputer in our pocket and check to see how much we had, where it was going, and where it come from. That radically changes things. But now let's move things forward just a little bit more to think about today. Now, fundamentally, innovation is still a challenge. Going from that smartphone to something that we can make our data ubiquitous comes with a lot of challenges. First of all, there's massive complex infrastructure that goes into all those banking organizations. To be able to pull that data together and make sure it's accurate is painful. It takes a lot of effort. When we think about the legacy applications that come as a result of that, they're primarily driven by some of those infrastructures, but also the regulations that come along with it. Things like KYC, know your customer, or AML, anti-money laundering, really sort of drive a lot of those requirements and introduce a lot of complexity. So we have banking as an industry has a lot of custom solutions, a lot of things that is completely unique to this particular bank or this tier of banks and has no customers outside this. As a result, we have a lot of challenges that come with this. But we need to take a step back and we need to think about what the purpose of a bank is. The ability to move, to save money, to transfer money around becomes really important because fundamentally, every company needs to be a technology company. They need to meet their customers where they are with better solutions. So let's think about what this looks like practically. We believe that APIs enable this transformation. It's not a big surprise. I'm an API guy. I have been for about 15 years. But let's stop and think about what an API does. To explain this to people, I usually use the analogy of an ATM. If you're like most people, you don't go to the bank very often anymore, 2-3 times a year. But sometimes you still need to get cash. Now, instead of going to the bank, going during open hours, going to a teller, withdrawing money, we just go to an ATM. Now, the banks are smart. They said, well, customers need to get this cash at various times, various places. So instead of forcing them to come to an ATM, even at our branch location, let's meet the customer where they are and embed this ATM in a gas station, in a grocery store, at the hospital, places where you're already going anyway. Now, the benefit of that is they've taken all their features and functionality, something they're particularly good at, and met their customers where they are. That's what an API does. An API allows us to take some features, functionality, some data, something that we do better than anybody else, and meet our customers where they are. If you think about it, Google Maps is the exact same way. They've taken the power and ability of a map along with GPS location information, and they literally put that in your hand. So the odds of getting lost, of being able to find your location, they all get a lot better. So obviously, this helps us extend our customer reach. We can be more involved in our customers' lives when they need us to be, which increases revenue. Because if we're being able to plug in and do more things with the customer, more likely they're staying in our ecosystem. They're not looking at competitors to solve problems that we're actually pretty good at. And the flip side of this is this stimulates innovation, both internal and external. On the internal side, this allows us to build an API once. We can build this component once and reuse it across our entire ecosystem. So no longer do we have 3, 4, 5 teams building the same component over and over and over again. We have one team doing it well, and 4 teams reusing it. So from a development perspective, we just freed up a lot of time on everyone's schedule. We decrease potential security issues, and realistically, reusing those components is empowering. It lets us do a lot more things faster. And on the external side, the same things apply. When we take something that we do especially well, better than anyone else, and we allow people to leverage that, not replace it, but leverage it, we end up with some cool possibilities. Now, as a result of those cool possibilities, we end up with a lot more opportunities. So increased customer acquisition. We can run into things where we can say, well, because we know what a customer is doing, what they want to do, how they do it, how they've been doing it, we can now address their problems better. We can address those issues better, faster, cheaper than any of our competitors. That's a good place to be. And in fact, when we extend this out, we say, well, let's go ahead and plug this into an entire ecosystem of tools. Well, now we can help our customers make better decisions through budgeting tools. We could say, because you're doing these things, you could save this much money by doing it this alternative way. We could sort of blend into their life in ways that are helpful and at the same time not intrusive, which blends into that seamless customer experience. But at a practical day-to-day level, internally to the organization, we can modernize our infrastructure, because fundamentally making our infrastructure easier, cheaper, more secure to maintain, the better off we're going to be. The more flexible we can be, which means we can adjust to market changes and opportunities that much faster. So this is where we want to go to. We want to go to an ecosystem which allows us to share information from all of our financial institutions, whether that is banking, whether that's an investment account, whether that's your credit card account. We want this to be completely transparent across the board. And there's some benefits that come with that. The quick and easy one is the one we are all probably familiar with on a day-to-day basis. We have your favorite mobile banking app for your bank, and it uses an API behind the scenes to pull that information together. This is the 101 elementary level. This is basically where everyone started. And it's a good place to start. It's not enough. So let's expand it out a little bit. And let's now create a mobile banking app or an aggregator app to pull information from a variety of sources. Now that we have that variety of sources available, we can have a better picture of the consumer and what they're trying to do. In fact, we can help them make better decisions throughout, because we could say, well, because you shopped here, you have these benefits, where if you change your behavior in this way, you might get these alternative benefits. Which ones are more useful to you? But let's go one step further. And let's say you're a consumer applying to borrow, whether that's a credit card or a mortgage or whatever, it doesn't really matter. Fundamentally, the way it used to work is a lot of lenders had to trust a user to provide a snapshot of their information at that given point in time. Now we end up with a little bit of a problem, because we don't know what that looked like over time, over history. What did that look like 3, 6, 12, 24 months ago? Well, if we can provide information from the bank itself to say, this is what that customer's history looks like over time, we have better information to make those decisions. And better information sooner, easier, is always going to lead to a better decision. Now, this introduces a risk, because one, as a consumer, I need to make sure that I'm only providing this information to people I trust. But from the bank's point of view, they need to make sure I'm me. Because if we fail in either one of those things, we end up with a massive security vulnerability. So that we need to understand where identity plays a role in this. So that I'm going to hand it over to Venkat to talk about the implications of that.
Thanks, Keith. Hello, everyone. This is Venkat. I'm a senior product manager here at Okta. So let's look at role of identity. identity here. Identity plays a major role in this transformation. And let's look at 4 areas where identity, how is it evolving, and how it is powering these transformation. These 4 areas are compliance, financial sector, but across all industries. Regulations define standards for data exchange and the security around it. Not only that, it also offers guidelines for user data protection. Let's look at regulation in finance. It all started with open banking a few years ago. Open banking is a banking practice that provides third-party financial service providers open access to consumer banking, transaction, and financial data from different banks. And all of this are powered through APIs. Now, PSD2, or the Payment Services Directive 2, what this did was, it was a regulation which came into effect in Europe. It was based on open banking, and it enabled all the third-party providers to get access to transaction data across Europe. It opened up to new use cases that Keith spoke about. There is also financial APIs, which is called as FAPI. It's an OpenID working group that offers security and privacy recommendations for financial APIs. Following open banking and PSD2, we have tons of regulations coming up in different countries that mandate for strong security for APIs in regulated industry. An example would be CDR, the Consumer Data Rights in Australia. This is just finance, but you can actually flip this example and look at other regulated industry like healthcare. So in the case of healthcare, we have Smart on Fire, which is a regulation that describes and provides a way for EHR systems to make data available or accessible via APIs for consumer applications like Apple Health, and also mandates that these APIs require strong authorization. Let's look at privacy and consent. The importance of privacy and consent really is, it provides the user with transparency, awareness, and control. Let's look at this through 2 examples. The first example on my screen shows Aggregator app connecting to bank account, an example that Keith walked through. In that example, what happens is that the application, the Aggregator application, lets the user know what information it requires from the bank and why. This provides transparency to the user. For example, if you see, it shows the user that, hey, choose the account you want to connect to the Aggregator app. The user has to explicitly provide consent. This makes the user aware of what they are signing up to. The third thing is, these consent are also time bound in order to make sure user feels that they remain in control of their data. Not only that, if the user prefers at any point not to share this information, they can do so by opting out. This provides complete control for the user over their data. The second example is strong customer authentication. What is that? PSD2, as we saw earlier, has a component called strong customer authentication that mandates the user use of more than one factor when transaction greater than 30 euros is performed. What it basically does is the user is provided also the context of the transaction of what he or she is performing. So in the screen, they're trying to buy some suit from Zara. So by looking at the transaction, by looking at the amount, the user is completely aware, and he or she should be able to allow or deny the transaction to further process it. This actually increases cardholders' confidence in using online services and also reduces the potential for online fraud. Now, we looked at some regulations which are specific to these industries, but not only that, privacy regulations is the new normal. This all started with GDPR, and according to Gartner, privacy regulations across the globe have developed more in the past 12 months than they have in the preceding century. And also it says by 2022, half of the planet's population will have its personal information covered under local privacy regulations that are in line with GDPR. So we're already seeing this. The California Consumer Privacy Act went into effect earlier this year. Not only that, many states within US and also countries across the world are following suit with GDPR and coming up with their own privacy laws. The third area we're going to see is about strong authentication. What's that? We all started with simple username passwords when authentication came into effect. These are like simple passwords, and then they actually 81% of all hacking related breaches leverage stolen or weak passwords. Then we moved out to some kind of second factor, starting with security question. They are also really weak. So we moved on to OTPs that are based on SMS and software based OTPs. OTPs that are based on SMS are really weak and can be hacked and interpreted. So we moved on to physical tokens, but that actually forces the user to carry a token with him at all the places. That really sucks because if you lose the token, you need to find a way to get a new one and you can be basically logged out from the application. We see a new trend here. Applications are starting to leverage biometrics-based authentication. Let's look at more about that. The World Wide Web Consortium and FIDO working group, they came up with something called Web Authentication API recently. What is this? Web Authentication APIs allows servers of the application to register and authenticate users using public key cryptography instead of password. Let's look at in common terms what it does. It basically allows users to log into the application by leveraging strong authenticators which are built into devices like Windows Hello in Windows laptop and Apple Touch ID in MacBooks and in Apple iPhones. So what this does is instead of having to use password, they leverage public-private key pair that is created specifically for this website. The private key is securely stored only on the user's device, so it doesn't go out of the device. And also, web authentication APIs are natively supported by all the popular browsers, Chrome, Mozilla, Firefox, and Microsoft Edge. Now, what it basically does, authenticators are not only becoming stronger and secure, but they're also becoming interoperable by inbuilt browser support and also by leveraging inbuilt authenticators. Therefore, it's creating an ecosystem for better security and also for better user experience. How is this important in the case of finance industry? As we go back to our example, as I said earlier, PSD2, the component of the strong customer authentication, a component of PSD2, mandates implementing multi-factor authentication using a minimum of 2 distinct authentication factors, such as PIN, passwords, OTPs, and biometrics. Most of the banks continue to use OTP or SMS-based passwords today. They offer poor user experience and also can be like, it is also offers the security is also not that great. Banks will also have to transition to biometrics. WebAuthn and also leveraging these inbuilt authenticators are going to allow banks to seamlessly transition to using biometrics and also improve the overall user experience. Finally, if you're talking about API, how can we not talk about authorization? So in the case of API authorization, OAuth plays a major role. Let's look at the history of OAuth. OAuth came into existence in 2007. It was actually invented by employees of Twitter to allow easy sharing of photos with your friends. But after that, soon it gained popularity. In 2009, we had OAuth 1.0, and in 2013, we had the most famous OAuth 2.0. From then on, OAuth has become the de facto standard, and today every APIs use OAuth for API security. But if you really look at that, 90% or more, most of the applications are using bearer token. These are the access tokens of OAuth. What is bearer token? Bearer token are compared to like car keys. If you lose it, if someone gets hold of it, they can actually go for a ride. But bound tokens are like passport. Even if someone gets hold of the passport, the passport will be checked against the photo in the passport. The fingerprints needs to be matched, and also additional attributes has to be compared. Only if all validates, you can actually use the passport. So this constrains the passport usage outside of to whom the passport was issued to. So this is like bound tokens are like passport. They provide higher security. What happened here is today in OAuth, there is mutual TLS, which describes a method using mutual TLS authentication that leverages X509 certificates for issuing these bound tokens. But when you go to transport level security, this really takes a hit on the user experience. And also, these things cannot be used when you have browser-based single-page apps. The OAuth working group is actually working on a new spec, which is called proof of possession, which tries to implement sender constraint tokens at the application layer. What that means is you leverage public and private key pairs, which can live on your browsers, and they are specific to every application. This is kind of like a non-invasive addition to OAuth, and it also enriches the overall security. Also, the second example I want to give in this transformation to better security and building an ecosystem is moving to pushed authorized request. So I want to explain this in a common way. If you have seen the OAuth authorized request, you pass a bunch of protocol specific parameters when you make the request. And these are passed as query parameters. There is no cryptographic integrity. Requests can also be modified by attackers because of this. So as we started using OAuth for finance industry and regulated industry use case, we moved into the next secure model, which is signed authorized request. Basically, you take all the parameters, put it into a JOT token, and cryptographically sign it. Now, this offers better security than the previous conventional authorized request, but then there is also a limit when you pass this through browser, because browser is constrained by the length of the string. So you can pass complex authorized request calls. The industry is also working on a new spec, which is called pushed authorization request. Basically, what it does, it takes all the protocol specific parameters from front channel and pass it on in the back channel. This happens before you make an authorized request. You call the authorization server and make a post request with all the information. This enhances the OAuth security because you're moving everything to back channel. And also, you are now able to pass complex authorized request with no size limitation, because it's just like a post API call and the payload can be as large as it can be. And also, since you make a call beforehand, the OAuth clients are actually authenticated even before user interaction begins. This keeps inactive or attackers out of the way. I wanted to summarize what we saw. We see a pattern here when we move to the stronger security model. We are moving into cryptographically signed requests. An example is bound tokens. We are also moving protocol specific parameters from front channel to back channel. There is also this new OAuth methodology of moving from implicit flow to code flow with Pixie. What all of this is doing is basically moving the industry to a better security model and also build an ecosystem around that. And not only identity is doing its part, major browsers are also making efforts to build better security, like the same site cookies to differentiate first-party cookies from third-party cookies. I have listed some links here for recommended readings about the spec I spoke or the examples I walked through. Feel free to take a look at your leisure time. I will now pass it on to Keith to summarize.
Thanks, Venkat. So fundamentally, we need to understand that there's a series of trends effectively colliding all together at the same time. We have the industrial sort of cloud transformation. We want to be able to take more of what we're doing and break it up and move pieces of it to the cloud in safe, secure ways. At the same time, as part of that, we want to make sure that zero trust is baked in from the beginning, where we trust people as little as we can at the beginning, people and systems as little as we can at the beginning, and trust them progressively more over time as they prove themselves. Now, primarily, we've revolved this around financial services, but this is the exact same conversations and concerns apply to Internet of Things and healthcare at the same time. Because fundamentally, we have more devices connecting to more things, not just on the financial side, but on the healthcare. Not just our finances and our data and our financial well-being, but our physical and health well-being. We need to be able to sort of address those things together. And our view is fundamentally, you can't do that without bringing everything together in sort of a common view of things. So while the regulations are primarily pushing it, we believe that user consent, strong authentication, and delegated authorization pulls all that information together and makes it so that we can have a secure, safe, and fundamentally responsible experience with the information that we've been trusted with. And if we're not doing that well, fundamentally, we don't have any business being here. And really, the benefits come down to a handful of things. We want to make sure that standards-based, so that when somebody joins our organization or your organization and they start working with these things, that it's common nomenclature, it's common tools, it's common training, that they don't have to refigure it out and try to come up with your particular brand of your particular security protocol, that we all have a very common understanding. And as a result, we all have a very common view and we understand what the risks and trade-offs are. Fundamentally, that leads us to better security. If we all understand how things connect together and why, then we know where we can get creative, where we can add additional layers and additional components, and where we shouldn't. We don't need to create our own encryption protocol. We've been there, done that. We have better approaches now. But fundamentally, one of the other things is we want to make sure things are as interoperable as possible. One of the things that is probably the most important part between the transition from OAuth 1 to OAuth 2 is just the standardization that went behind it. We suddenly had this new view on what to expect, how things tied together, and why they tied together that particular way. It's a very powerful concept because not only do we have the standards to base things on, but now we can move more information around easier with less risk. This builds an open ecosystem. This allows us to be able to have a single sign-on scenario where maybe Okta isn't your identity provider. Maybe your bank is your identity provider. And so you start wanting to tie into other systems. And because we've got that open ecosystem, we might trust Capital One or Bank of America or Chase to be able to exchange that information back and forth in secure, reliable manner to be able to allow you to log into that downstream system. And now we can have trust across the system in reasonable, less risky ways. So that I want to say thank you. Hope you've enjoyed the session and definitely check out additional Octane 20 sessions. I hope you have a great time.